evening, ladies and gentlemen. Thank you so much for joining us for the first ever CNBC-TV18 India Exchange. I'm Shireen Bhan, and on behalf of the entire CNBC-TV18 team, we're so happy that you could join us here. It's a working day, and I know that it's not easy to take time out from work as well as your evening routine and spend your evening here with us. So we truly appreciate it, and thank you so much for joining us here this evening. So what is the India Exchange about? A couple of things, actually. We decided that since it is the 25th year for CNBC-TV18, it was an opportunity for us to bring together thought leaders, market experts, people who join us day after day on the channel to really create intimate evenings where we can look ahead, but also get some perspective on what we've been through as an economy and as a nation over the last 25 years. And that's what we're attempting to do. The overarching theme for this evening is the decadal dividend. Everyone's talking about how this is going to be India's decade. So our question to our panelists here, and we have many experts joining us here this evening, will be exactly that. What's the bull case for India? What is the thesis that they're working with? What will drive growth? What will capital chase as we look out at the next 10 years? But as Steve Jobs said, we can't connect the dots looking forward. We can connect the dots if we look backwards. So just to put some data points on the table, if you look at the last 25 years, and 25 years only because, as I said, CNBC-TV18 is completed 25 years this year, the Nifty has seen an annualized return of 13%. If you take a look at the period between 2014 to now, that's 10 years of the NDA, annualized return for the Nifty about 12%. If you look at the 2004 to 2014 period, 10 years of the UPA, an annualized return of 16%. It is election season. We're talking about what could potentially be the next trigger as far as our markets are concerned. And again, if you just look at historical performance, May 19, 2019, 6 months prior to the elections, we saw the Nifty up by 6% and about 5% post the next 6 months after the elections. And similar story playing out in 2014, in 2009, and in 2004 as well. So as we look ahead, we are going to, of course, ask our panelists to explain to us how they see the macros. And Samiran Chakraborty is here to kick things off this evening as he maps the macros with us. We have the two Manishas, Manish Chokhani and Manish Kejriwal joining us as well to discuss where the markets are going to be headed. And of course, as I pointed out, where capital is going to be moving. Are we on the cusp of unleashing the animal spirits that everyone's been talking about and everyone's been waiting for? Is it going to be an investment-driven growth or consumption-driven story that we will continue to see? Those are some of the questions that we will have our panelists address here today. It has been, for all of us at CNBC-TV18, a record-breaking 25 years. We are good at what we do, but that's not the important part. The important part is that we try and be better at it every day, and that's what keeps us going in our newsroom. So once again, on behalf of CNBC-TV18, thank you so much to each and every one of you for joining us today, for your support over the last 25 years, and we look forward to many, many more. Thank you, ladies and gentlemen. Without further ado, to kick things off, mapping the macros, Samiran Chakraborty, the stage is all yours. A big round of applause for Samiran Chakraborty.
Thanks, Shireen, and thank you, CNBC, for giving me this opportunity. Am I audible? Yes. You know, at times when the markets are doing so well, the demand for economists typically come down. We have a demand curve which is inversely proportional to the markets. So I'm just wondering why even CNBC gave me this opportunity to speak today. We are in high demand when the economy is not doing well. But today is a time when I'm going to just simply, that's why I choose 4 random questions. And I will try to give you my version of answers to those 4 questions, because I think most investors are asking me these questions. So let me first put the questions in front of you just to whet the appetite. So the first question is that the way the global economy is shaping up, is it a tailwind for India or is it a headwind for India? The second question that I want to attempt is India's growth too hot or too cold? The third question I'm going to attempt to answer is that, would RBI cut interest rates at all? Why? And the fourth question is that, and this is something which just happened today, that at a day when equity markets touched an all-time high, why is it that the currency touched an all-time low? So over the next 20 minutes or so, I'll try to delve into these four issues. So first, on global. Look, just a few months back, I used to say that everything around global is turning out to be good for India. Now, it's a bit mixed. So what is good is that global growth is not falling off the cliff, as a lot of people would have worried. Even in Citi, our house view was of a very slow global growth year of less than 2% global GDP growth. We have upgraded that a bit. The second factor that was a big positive to start with was that interest rates globally would be cut significantly. The market expectation was that Fed will cut about 125 basis points or so. Now, it appears that because of the slightly higher growth and slightly more resilient inflation numbers, the expectation of interest rate cuts have come off. The market expectation is about 75 basis point rate cut, but for all practical purposes, now people are confused when and how much rate cuts are going to happen. But apart from these two, the most important thing for India has always been commodity prices, particularly oil. And this is the new development which is slowly being baked into markets, that oil prices has creeped up to $90 per barrel. I am no expert on geopolitics to tell you exactly where oil prices are headed. In fact, in Citi, our house view is that oil prices will come off from these levels. But just in case oil prices go up, let me give you the sensitivity of India's macro to oil prices. So the sensitivity is that about 10% increase in oil prices leads to about 15 basis point decline in India's GDP growth, and about 30 basis point increase in India's inflation, and about 0.4% of GDP increase in India's current account deficit. These numbers are not scary, particularly given that we are starting off from a very stable macro and growth environment. But the big but is that globally, the favorite trade for investors is to short Indian assets whenever oil prices go up. This is an instinctive reaction. And I'm worried that when a particular threshold of oil prices are reached, there could be some negative effect on investor sentiment regarding India, not as much a worry on the macro factors of oil price impact. I'll not have time to delve on two issues globally, but I think from a medium-term perspective, which we have to be worried about, which is that how this huge increase in global public debt is going to be unwound and how emerging markets would be impacted by that. And the second issue is connected to it is about global liquidity. In my view, global liquidity is still very ample, flush. When this liquidity is tightened, how that impacts EM assets is something also we need to understand. So that's broadly the global backdrop. If I quickly move on to the second issue of, is India's growth too hot or too cold? The debate starts from these two concepts that economists use of GVA and GDP. As you know by now that our GVA growth is around 6.5, and our GDP growth is around 8.5, and everyone is scratching their head to figure out how this 200 basis point of gap can be explained. I think it's a useless debate. Economists will like the GVA number because that's how the data is collected. But it's also true that for years together, we have been using the GDP growth number for policy making, for our commentary, everything. So just because the GVA number today is what fits our perception does not mean that we can change the metric and move everything to GVA. So I suspect that policymaking will keep on happening on the basis of the GDP number, not on the basis of the GVA number. But even if we believe the GDP number, it's quite true that it's a two-paced economy. Two-paced because the investment side of the economy is doing significantly better than the consumption side of the economy. Investment is growing at double digits for 3 consecutive years, which has never happened in India's history. And consumption is the weakest that we have ever seen, barring crisis periods. I have a strong suspicion that the consumption numbers finally will be revised upwards, but be that what it may, there is still going to be a gap. The issue, and Shireen mentioned this, that whether India's growth will be consumption-driven or investment-driven. If you look at last 2 decades of India's strong growth, consumption used to provide 400 basis points of GDP growth on an average every year. So if investment was growing at 8–10%, we would easily get 7–8% growth. So it's important for consumption to come back to that level of 400 basis point contribution to GDP growth. So the optimistic spin to this is that the investment growth that we are seeing now, that will create the jobs, the income, and the demand and the consumption with a time lag. The pessimistic story is that if demand is not picking up, then ultimately the investment side will also suffer, private capex growth will not happen. And that leads me to the investment side itself, where there is a two-pace. Two-pace because the perception is that public capex is driving the entire investment growth and not private capex. When will private capex pick up? But interestingly, if you break the investment data, only 25% of investment comes out of public capex. 35% of investment is private capex, and 40%, the largest part of investment, is actually household capex. And household capex, in turn, is mostly real estate. I would argue that the public capex and the household capex is what is driving our investment growth now, with some support from private capex. But over a longer term, my sense is that we will not go back to the 38–39% investment to GDP that we had seen in the past. We are utilizing sweating capital much better than what we were able to do. Our productivity is much better. So even with somewhere around 35–36% investment to GDP, we should be able to generate the right kind of growth for us. And then lastly, within consumption, there is also a view that there is a K-shaped consumption. The top-end consumption is growing better, the bottom end is not as much. I suspect what is going on here is that the cumulative inflation over the last 4 years have been more than 30%. So people who have got income growth of more than 30% are able to cling on to the consumption basket, grow their consumption. But people who have not got that kind of income growth, that's where the consumption growth might have suffered. There is one trivial way of presenting this through urban versus rural. I'm generally not too much in favor of that. In India, it's difficult to break this up in a watertight way. But going forward, our sense is that there are some headwinds developing on the urban consumption front, where there are some tailwinds developing on rural consumption. So maybe this gap will converge as we move forward. But overall, if you look at it, the RBI is most likely to increase their growth forecast for next year. Would probably be around 7–7.5% growth next year. But the big question, and I'm not going to give an answer to this question as such, but just put it up in front of you, is that should we be happy with 7% growth? Why? Because of this unique conundrum that we have now, that given our demographic dividend, which is going to last, in our view, for a decade, should we be aspiring to grow at closer to 10% to get the maximum advantage of this demographic dividend? Or should we be looking at the global growth at 2–3% and say that in this turbulent period, if we can get even 7%, 7.5% growth, that's good enough. I think depending upon which view you take, the direction of policy could be very different. You would have to be much more radical in your policy thinking if you aspire to grow at 9, 10%. 7%, 8% growth is a very conservative policy approach, according to me. Let me quickly move on to the third topic, which is, should RBI cut? Again, there are three aspects of rate decision. One comes from growth, one comes from inflation, one comes from financial stability. As we were just arguing, India's growth is more or less fine right now. There's no need or urgency to cut rates for supporting growth unless you believe in my thesis that India needs to grow at 9, 10%. So a little bit of support from monetary policy is warranted. The second aspect is inflation. Big dichotomy in inflation. Headline inflation is still much above RBI's target of 4%, but we are consistently seeing core inflation numbers to come off, which shows that monetary policy is working. But I suspect that till RBI sees actual headline inflation coming closer to its 4% mark, they will wait on rate cuts. And the third factor is financial stability side, which is a luxury to delve into when growth and inflation are fine. If growth inflation was not fine, we would have seen everyone talking about growth and inflation. But because we are cyclically in a good position, this is probably the right time also to build buffers. And maybe that's one reason why RBI might delay the rate cut. In Citi's house view, we think that the first rate cut happens only in October and not before that. But RBI has already ensured that the liquidity in the system has improved compared to the last 5 months. The overnight rates have come off, the short end of the rates have come off, the so-called stealth 25 basis point of rate hike that had happened, that 25 basis point of rate hike has been rolled back in some sense. So this is the first step of monetary policy easing, which RBI has already embarked upon. The second stage will be when RBI will be changing the policy stance from withdrawal of accommodation to neutral. Our sense is that somewhere in the middle of the year, and then with a couple of policies gap, we might actually see the first rate cut coming. The reason we are often asked is that why RBI is different from other central banks. Why is it that Fed will cut and RBI will not cut? The big difference is that most of the other central banks are working on this rather vexed concept of real policy rate. You will see that most central bankers are saying that real policy rates are too high compared to what those economies are used to. In the Indian context, with our current expectation of about 4.5% average inflation for FY25, our real policy rate is around 200 basis points, which by Indian standards is just fine. It's not too high. So there is no urgency on RBI's part to cut rates based on real rates. Whereas if you look at US, in US a year real rates are probably 300 basis points now, given where their rates are. And by their standards, 300 basis point is a very high real rate. So that's why it's possible that RBI will not match the Fed one for one in their rate cutting, and Indian rate cutting cycle might be a very shallow one with about only a 50 basis point rate cut. And my personal belief is that the impact of rates on India's growth is overhyped. India's growth is much more structural in nature and does not require this small cyclical support from the central bank policies. I'll go to my last point, which is about what I was saying, the difference between how the equity markets are doing versus how the currency markets are doing. My sense is that India's external sector today is probably the best health that we have ever seen. Why do I say so? Because if you look at current account, you'll be surprised that for the January-March quarter that just went by, current account in India should be in a surplus of about 1% of GDP. We are used to 2% of GDP deficit in current account. Now we are running our current account surplus. In fact, our projection is that for the foreseeable future, India's current account should be less than 1% of GDP. I should touch wood somewhere that oil prices don't go up to $100, then all these forecasts will go for a toss. But if oil prices stay somewhat benign, we are now entering a period of much better current account than we have ever seen. And that's because our service exports are really going up. In fact, we will not be surprised if very soon our service exports will match our merchandise exports. In fact, you'll be surprised that our IT exports are now reaching the level of Saudi Arabia's oil exports. That's how large our export side has becoming. So current account is turning out to be very good. On top of it, we might be flooded with capital flows next year. One, because of this bond index inclusion, which in our view could easily bring in $30–35 billion of inflows, much more than what the mathematical way of looking at it. The debate is more on FDI. As some of you will be aware that the FDI numbers have been coming off for the last couple of years. I would argue that the decline in FDI, partly it's global in nature, but partly it's also because there has been more outflow of capital from India. The gross inflow number has not been impacted as much. In fact, we have our ways of web scraping data to figure out the FDI intent into India. And I would say that from 2023 onwards, the intent of FDI into India for the first time has crossed the intent of even FDI into Vietnam, which was the case earlier. So I'm somewhat more comfortable to project that the FDI numbers going forward would improve. On top of it, this current account improvement and the portfolio flows should give you a massive BOP surplus of $60–70 billion next year. But the but is that there is no correlation between balance of payment surplus and currency in India. In last 10 years, there has been only 1 year of currency appreciation, while all the years have been BOP surplus. So this is the meat in the market that if you have a BOP surplus, the currency should appreciate. It doesn't work like that. Currency depends on two things. One is inflation differential. Our inflation differential with the rest of the world, if it increases, then the currency needs to depreciate to match that. This has been the case in the past. We have an inflation differential with the rest of the world, and that's why the currency typically depreciates. And the second thing is about RBI's view on what the true valuation of the currency should be and how much intervention RBI is doing. RBI has of late demonstrated that they want an extremely stable currency. We might ascribe motives on this. We might say that this is a precondition for rupee being internationalized, being used as a denomination currency in trade, maybe. Or it could be because of keeping our global borrowing costs low by having a very stable currency. But whatever it is, this seems to be a big driver of why the currency has been kept where it is. So while we might argue that, look, the rupee has reached an all-time low today, what gets missed is that if you look at 2024, rupee is actually the best performing EM Asian currency. So sometimes just looking at the USD INR rate, we might get a very different impression of where things are versus the actual reality out here. So let me quickly summarize some of our house views just because I was asked to put the numbers there. So we think GDP growth of close to 7%, maybe a tad lower. We think inflation in India next year should be about 4.5%. the first rate cut maybe in October, but when we get the signal of that rate cut, 10-year bond yields should start coming off. So we are projecting a 10-year bond yield of about 6.5% by end of the fiscal year. Currency, a very narrow range of about 2% between 82.5 to 84. And overall, I would say that I would end by saying that India is in the right position right now to start expecting on preparing for a 8 to 10% GDP growth rather than a 6 to 8% GDP growth, which has been the story of the last decade. Thank you again for the opportunity. Thank you.
Well, thank you, Mr. Samiran Chakraborty, for that fabulous summary of the state of the macroeconomy and to target for an 8 to 10% growth and not be satisfied with that 6 to 8%. And of course, your view that there is no need for a rate cut. I'm sure bankers like Mr. Vaidyanathan will agree because bankers love high interest rates. But the rest of the market really has been clamoring for a rate cut for private capex to really pick up. I'm wondering if you had any counter question to pose to Mr. Chakraborty, Mr. Vaidyan.
Samiran, that's a wonderful speech. I think all of us really appreciated it. If India targets, say, 10% instead of the 7% going on right now, is there any, what are the safeguards India will have to do so it doesn't overheat and go into inflation mode?
Thanks, sir, for asking me this question, because it gives me an opportunity to present my macro framework to you. My macro framework is that historically, India's supply curve was very fixed. And whenever demand used to go up, we used to hit that supply curve. It used to turn inflationary, higher current account deficit, currency depreciation, and the cycle used to turn. Now we have the opposite problem. Our supply curve is very flexible because we are doing a lot of investments. But the demand has not picked up as much. So this gap between supply and demand is actually causing core inflation to come off. So inflation is coming off quite materially. Current account is not a problem at all. Currency is not a problem at all. So we now have an opposite problem of how do we create demand so that we move this demand curve up to that supply curve. So at this moment, given where things are, I think we need to throw out our baggage of the earlier cycle of thinking that whenever we will have higher growth, that would cause these inflationary current account currency problems. If we are able to do that, we will be able to run a more radical policy than what we are doing currently.
Well, we have some of the market veterans sitting right here, Mr. Ramdev Agarwal, Mr. Prashant Khemka. Any questions for our guest?
What is the reason, most of the economists, they are getting the growth rates wrong? And as much as by 1.5%. Even RBI economist has got it wrong. I don't know whether you got it right or wrong.
So, as I was mentioning that, we economists, we love the GVA number, not the GDP number. That's how we forecast things. And if you look at it, the GVA forecast for economists came almost in line with the GVA release of the government. The gap between GVA and GDP is this somewhat vexed concept of net indirect taxes. To be honest, we have not been able to figure out where this net indirect taxes data come from and how this is exactly measured. And that's why in quarters, when the GDP data, this net indirect taxes grow by 32%, it becomes impossible for economists to predict that. Our GVA forecast was 6.6. The GVA came exactly at 6.6. But the GDP, we were forecasting maybe 6.9. GDP came at 8.4. That's how the problematic part is. And, but I must admit saying that I can't, on the basis of that, suggest to policymakers that shift to GVA. Why? Because historically, for many years, we have been tracking the GDP and making policy on the back of that. Just because in 1 or 2 readings, my GVA and GDP numbers are not matching, I can't move back to GVA. That's also not a practical suggestion.
Okay, well, I'm going to take it over from Ritu, and I'm going to toss it over to the audience. If anybody has any questions for Samiran, we're going to go over to this gentleman here. Yeah.
Samiran, if one looks at the subsidy numbers for October, December last year, they were 1.5 lakh crores. And this year, I think they've mysteriously come down to 75,000 crores. And all of us know that the government accounts are kept on, not on accrual basis, but on cash basis. So, I mean, just to play devil's advocate, I think if I want to jazz up the GDP numbers just before the elections, this is the last print, I believe, the one that we got. I think if you have that 75,000 crores of gap, which even if I just pay on 1st of Jan, instead of paying before 31st December, that explains a large part of the difference between GDP and GVA. And those numbers are available, sort of, in the public domain.
So I know exactly where you are coming from. The problem is that we used to have this proxy indicator of net indirect taxes, where we used to calculate the gap between the indirect taxes and the subsidy and the growth rate of that. Till COVID times, that proxy indicator used to work very well. Post-COVID, that proxy indicator is not working that well. So I would say that the problem is not for this quarter. In fact, perversely, this quarter, if I had used my proxy indicator, I would have got exactly the same result as the government has got. But because we lost trust on that proxy indicator, we are not using it anymore. Maybe going forward, we will start thinking about it this way, but whether the government did not give subsidies in this quarter and gave it in fourth quarter just to show the GDP numbers in good light, that's a question which I am in no position to answer.
Samiran, thank you so much for that absolute masterclass as far as mapping the macros are concerned. Please give him a big round of applause. Personally, I think I'm going to sort of download that episode back when I'm home and watch it again. It gives us such a solid framework to analyze, macros in India, really. Our next session is